Most people spend years paying for decisions they no longer support. The psychological weight of a past investment often forces individuals to maintain failing projects, outdated careers, or stagnant portfolios. Research in behavioral economics suggests that the fear of loss is twice as powerful as the joy of gain, leading to a paralysis that drains millions in potential capital over a lifetime. This analysis explores the mechanism of zero-based thinking, a mental model used by high-performance executives and institutional investors to strip away the baggage of the past. By the end of this discussion, it will be clear how this single cognitive shift can fundamentally reorient a person's trajectory toward growth and efficiency. In the world of finance, a sunk cost refers to money that has already been spent and cannot be recovered. However, the human brain struggles to accept this reality. Statistics show that the average person will stay in an unrewarding career for over 7 years purely because of the time already invested in the degree or training. This is known as the sunk cost fallacy. It is the irrational drive to continue an endeavor if a significant investment has been made, regardless of whether the current costs outweigh the future benefits. It is the reason companies continue to fund failing product lines, even as market share drops by 20% or more annually. Consider the impact of a stagnant investment portfolio. If an asset has declined by 30% over 3 years while the broader market has risen by 15%, the logic of the sunk cost suggests waiting for a recovery. Yet, the capital remains trapped in a low-performing vehicle, missing the compounding power of the broader market's growth. The psychological toll is equally significant. When a firm or an individual commits to a path that is no longer viable, the opportunity cost begins to accumulate. Opportunity cost is not a line item on a tax return, but it represents the real value of the best alternative that was skipped in favor of the current choice. In a study of corporate decision-making, it was found that nearly 40% of projects are continued past their point of viability. This creates a drag on the entire organization, siphoning off resources that could have been used for innovation or expansion into more profitable sectors. Recognizing these invisible weights is the first step toward high-level strategic planning. Without a mechanism to audit these legacy decisions, growth remains hampered by the ghosts of yesterday's choices. But the real danger isn't just lost money. It's the refusal to ask a single, difficult question. Zero-based thinking is defined by one core question. Knowing what I know now, would I start this again today if I weren't already involved in it? This question bypasses the emotional attachment to the past and focuses strictly on future utility and current data. If the answer is no, the next logical step is to determine how quickly and safely one can exit the situation. This applies to everything from a 10-year business partnership to a specific recurring monthly expense. It is a process of clearing the whiteboard and rebuilding from a foundation of current reality. This habit requires a radical level of honesty. Most people prefer the comfort of a known negative to the uncertainty of an unknown positive. However, market leaders understand that the status quo is often the most expensive option available, as it carries the highest opportunity cost. By applying this logic, a business owner might realize that a client who provides 10% of the revenue but consumes 50% of the staff's time is actually a net loss. Zero-based thinking provides the permission to terminate that relationship and reallocate those hours toward high-margin acquisitions. In personal finance, this looks like auditing every recurring subscription and investment. If a person would not sign up for that $100 a month service today, knowing its actual usage, it is a candidate for immediate removal. The goal is to ensure every dollar and every hour is earning its place in the current budget. This isn't about being cynical or impulsive. It's about being objective. It is the practice of auditing life with the same cold precision that an auditor uses on a balance sheet. When this logic is applied at scale, it transforms entire balance sheets. In the corporate world, this concept is formalized as zero-based budgeting, or ZBB. Unlike traditional budgeting, which takes last year's spending and adds a small percentage for inflation, ZBB requires every department to start at zero and justify every single dollar of their requested budget for the coming year. When major consumer goods companies adopted this model, they frequently discovered that up to 25% of their operational spending was being directed toward legacy processes that no longer added value. By stripping away these inefficiencies, firms have been able to increase their profit margins by hundreds of millions of dollars. Institutional investors use a similar approach when evaluating a company's leadership. They look for CEOs who are willing to divest from a profitable but slowing division to pivot toward a higher growth industry. This was famously seen when major tech giants transitioned from hardware sales to cloud-based service models. This institutional rigor prevents mission creep, where an organization becomes too broad and loses its competitive edge. By forcing every department to prove its ROI every year, the company remains lean and responsive to market shifts, such as the rise of automation or changes in consumer interest. The IRS and other regulatory bodies often see the results of these shifts in the form of massive restructuring. While the transitions are complex, the data suggests that firms using zero-based principles often see a 10 to 15% increase in share price over the 3 years following the implementation of such a strategy. The common thread is the refusal to accept the past as a template for the future. This institutional rigor reveals a fundamental truth about resource management. Efficiency is not just about doing things right, but about doing the right things. Once the dead wood of legacy decisions is cleared, the most critical phase begins: reallocation. Every hour of time and every dollar of capital that is liberated by zero-based thinking must be directed toward the highest probability opportunities available today. If an individual recovers 10 hours a week by dropping a low-value project and reinvests that time into skill acquisition or business development, the compound effect is staggering. At a professional rate of $100 per hour, that represents $52,000 of reclaimed value per year. In the investment world, this is the difference between holding a mediocre stock for decades and rotating capital into sectors with strong tailwinds, such as renewable energy or artificial intelligence. Reallocation is the engine of wealth creation, but it is impossible without the courage to sell. The data shows that the most successful individuals are not necessarily those who make the best initial choices, but those who are the fastest to correct their mistakes. They treat their time and money like a professional fund manager treats a portfolio, constantly optimizing for the highest possible return on equity. This habit transforms a linear life into an exponential one. By constantly pruning away the low-yield activities, one ensures that their resources are always focused on the most potent 20% of actions that drive 80% of the results. This is the Pareto principle in its most practical form. Ultimately, the habit of zero-based thinking is about freedom. It is the freedom to change direction, the freedom to admit error, and the freedom to pursue the most lucrative path available right now. It is the mindset of those who view the future as a blank canvas rather than a continuation of a cluttered past. The most important insight to remember is that every day is a new opportunity to re-justify the allocation of one's limited resources. If this changed how you think about capital allocation, the next video breaks down the specific mechanics of the Pareto principle in modern business.